We're snorting cap rates and shooting up cash flow here at Deal Junkie.
Welcome back to Deal Junkies. We are here today with Gabe Johansson, myself, Dane McKinney, Trevor Howard, and our special guest, Ryan Gibson. Welcome, Ryan.
Hey, good to see you guys. Thanks for having me on.
He's with Spartan Investors. He actually started Spartan Investors, I want to say 10 years ago. They now own 6.5 million square feet of self-storage across 15 states. Which
That's
equates to what's the dollar amount in real estate that is?
I think I'd say we're in between about 900 million and $1 billion of assets, depending on what cap rate you put on it.
Depending on today's interest rate.
You should use a 3 cap and have like $2 billion worth.
Yeah.
Exactly. That'd be nice.
$1 billion. Nice. You got to up your game, Ryan. $1 billion. That's all.
I know. Well, we've been sleeping a little bit. No, I'm just joking.
That's impressive. All in storage, huh?
All in storage. We do have a couple of stray RV parks out there, but for the most part, it's all self-storage.
I love it.
Were those RV parks tied to a self-storage deal, or were those just one-off kind of?
No, that was us being distracted in 2017 and 2018 when we were first getting started in self-storage. We bought those 2 parks, and they're still, one of them's producing pretty good cash flow, and we're looking to sell those basically now. If you know anybody interested, but our focus now has been 100% self-storage. We don't do anything else. We don't focus on a million different asset classes or things like that. Now, when you buy self-storage, to your point, sometimes it might come with a restaurant or a car auto body shop or some industrial flex or some office space, but those are really ancillary to our primary business, which is running self-storage.
How long in the process were you, Ryan, when you realized storage was your lane that you're supposed to stay in?
Yeah, that's a great question. So our company started in 2014, so just about 11 years now. And we started in single family rentals and developing condos and houses. And I would say in about end of 2016, we really got focused on what we want to build Spartan on. And we looked at an evaluation criteria of the 3 E's. We wanted something that would be easy to own, easy to evict, and easy to maintain. And then when we fell upon storage or learned about self-storage, we looked at its performance over the last 40 years. And it's been recession resistant for basically through every last major recession, starting in the 90s to today, the dot-com bubble burst to 1987, the dot-com burst in 2000, the great financial recession in 2008, and then COVID. Self-storage has really done very well in these recessionary times. And when we kind of got to know about self-storage, it was because people use self-storage for really 70% of our customers use self-storage for one reason, and that's because they're going through a life event. They're divorcing, downsizing, they're having kids, they're changing jobs, they're getting divorced, whatever it is, and they're moving. And so that never stops. People think that, this is kind of a joke. Like, people use self-storage because they got too much crap. That might be true, but a lot of our customers are coming to us because they're going through some kind of life transition. So that's 70% of our business. And then the other 30% of our customers own or have a business, and they're using self-storage for a business need. So when we kind of started hearing about that, we're like, this is an industry that's going to be around for a long time. And we've been right so far. And so that's when we kind of pivoted over into self-storage.
With your RV parks you're trying to sell, have you talked to Jan about selling it to him? Because we've been telling him to try to do bigger deals.
I have, but, we're not in any big hurry to sell. We want to get the right cap rate handle on it, so it's all good.
Something we're at the early stages of where you were at that point, and we see the shiny object of like, oh, here's this industrial deal that seems to make a lot of sense. Would you just recommend stay in your lane and stay away from kind of diverting?
No. I think it's good to taste the menu when you're first getting started, and then kind of getting a feel for what you like. I'm not saying you shouldn't. I don't think somebody should be distracted per se, but I think it's okay in the beginning trying some things out. I mean, what's cool about real estate is industrial, office, retail, self-storage, single family, multifamily. There's so many different things you can do. And like, I would encourage people, like, try a couple of deals and see what you like. And, kind of get your flavor and dial in what your criteria is, like, I don't want to deal with tenants, or maybe people really like dealing with tenants, so it really just depends on what you want to do. And I wouldn't discourage you from trying a couple of different things, but eventually, if you do want to grow and scale a big organization, I think I would encourage people to think about maybe focusing a little bit and saying, hey, because if you think about how much what we do as operators and deal finders is we are really niched into what we do. We know the neighborhood like the back of our hand. We know the asset class like the back of our hand, and we want to know how to get the deals. And in order to go really deep in an industry, you got to be focused on it. So, like, for example, we're going to trade shows and we know all the brokers. Like, we have 125 brokers nationwide on our list. We know all of them. We talk to all of them. We're meeting with them. We're going to the trade shows. We're doing team building events with them. We're talking to them on a regular basis. That, to get the really good deals, that's what you got to do. And it's hard to do that across single family, retail, office, industrial, car washes. I mean, you can't possibly be getting the best deal flow across 10, 12 different asset class types. So eventually you kind of niche into what really works for you, and that gives you your special sauce.
Yeah, and to give you reference on us too, because we'll have a bunch of specific questions. We've acquired about like 75 million worth of apartments. So that's ground up construction we do, and then just buying existing like value add properties. And then Gabe, he's been doing this 11 years or so, and he has like a personal portfolio of about $250 million. But we'll ask you a bunch of specific questions later because you've already gone down the path we're trying to emulate.
Yeah, I'm interested to know how is Spartan set up? What's your team look like? How many people are there? Are you vertically integrated? Like, you talk about management and wanting to be able to evict easily, maintain easily. I'm guessing you're doing a lot of this stuff yourself in-house?
Yeah, we are. So we're fully vertically integrated, meaning that if we find raw land, we will take it from trees to keys. So we'll entitle the land and go take it through all of its permitting, rezoning, conditional use permit, whatever it might be, and we'll build a brand new facility from scratch with our own contractors. So we actually are licensed in over 15 different states, and we have a construction team full time, over 16 professionals, and we have site superintendents that travel the country. So we've got a guy up in Bellingham who lives in Vancouver, Washington right now, building our Bellingham site. He just got done building our Oak Harbor site, and he's going to transition and build one over in Wenatchee this year. So we have all different types of we have the vertical construction piece down, and then once we build the site, the keys get thrown at our property management company, which is a national brand called Free Up Storage. And so we'll then lease up the facility all the way. We're even so vertically integrated that we source all of our own debt. So our internal capital markets team will run a process. We'll find the best debt all the way across the country, across our 45 different lending relationships that we have. And we get really good rate and terms on deals, and then we'll operate it. And then we also source our own equity. So we're doing the whole thing for real. I mean, we are fully vertically integrated. We have a president of our construction company who runs that whole vertical. We have a sort of a president of Free Up Storage who runs that entire vertical. And then myself and Scott Lewis are the co-partners of the whole thing that owns all these things and rolls them all up. And then sometimes we buy self-storages that are already existing, and we operate them for cash flow. So really, we're doing the whole gamut. We have 175 employees. We have 3 offices. We have one in Denver. We have one in Seattle. We have an office in the Philippines, our own office there. We have 58 people over in Manila. So we're all in with a.
Do you do any third-party work with the property management or construction, or all in-house?
Yeah, so we build about $100 million a year in self-storage projects, and about half of those are for our own projects, and the other half are for other clients. So we're building for other self-storage operators. So if you're listening to this and you're like, man, I'm thinking about building, or I got a project I want to build a self-storage on, and you want us to throw in a bid, we'll actually bid it. And we've built from sea to shining sea. We're building one right now in Port Wentworth, Georgia, and we're building one in Bellingham, Washington, and just finished one in Oak Harbor. So we are coast to coast. We build a lot in Texas, a lot in Florida, in the Carolinas, et cetera. So we built in the middle of the country. So we'll do third party, and we'll do. I think what's really unique is we'll actually permit the property as well, help you with design, build, and take it all the way through to the end. And then if you're like, hey, I don't really even want to operate it, we'll let you guys operate it. We do the third party management as well.
And is the benefit to that just additional income to your companies? Like that's the reason being, rather because it's more work now. You're dealing with third party and you have more headache.
Yeah,
it's worth it. You find?
Yeah, a couple of things. Additional income for third-party management, but anybody who's in real estate knows there's really kind of one reason why you do 3PM, which is you want to buy the property when the seller wants to sell it. That's really the biggest benefit. And if you're running a turnkey, we don't do turnkey property rental management, but the companies like that also want to get the commission when you sell it, right? Those are kind of your two reasons, to get the listing and then get the property when it sells. And that's a big part of why we do it, but we also... it strengthens our brand as well, creates a bigger network of self-storage facilities. We won't manage every self-storage facility that comes across our desk. There's some markets where we're not interested in going there. So that would be one where we wouldn't, but if there's markets that kind of fits within our footprint or where we want to scale to, then it makes a lot of sense.
Yeah. And we're kind of getting ahead in the story, but let's dive backwards and then learn more about how you dove from the W-2 job into this investment journey.
Yeah, absolutely.
So you started out as a pilot, right? You weren't you weren't much of a real estate guy at the beginning. You started flying and then figured you'd buy some of that stuff on the ground.
That's right. You just look for the blue tarps when you're looking down on the world, right? So, no, I have a funny story. I started selling Cutco knives when I was in high school, and I don't know if you guys have ever dealt with the Cutco knives thing, but. Sold $100,000 of Cutco knives, made $50,000 when I was a senior in high school, paid for all my flight training in cash. But, that was cool. Wow. But what I didn't realize at the time was that I learned sales. I was learning how to meet people, build rapport, drive around, manage a calendar. And I didn't realize that I was learning probably the most important skill you can learn in business, which is how to sell. And got my wings, got out of the airlines. I was an airline pilot at 21 years old. And I was flying for Northwest Airlines, a little company called Mesaba Airlines based out of Detroit. And it was awesome. Got into the jet for the first time. I was flying from Minneapolis to White Plains, New York, and got to my layover. And I looked over at the captain. I said, okay, what do we do? What do you do in White Plains, New York? He's like, whatever you want. And I was like, okay. He's like, well, we're there for 24 hours. What do you do? He's like, I don't know, watch football and grab a bite to eat, maybe hit the gym. I was like, oh crap, I'm in the wrong industry. Yeah, I'm not going to be able to sit around hotel rooms for the next 45 years. So, love the job, love flying, love the people, but just my head started turning. And of course, I read all the books that I read all the Purple books, the Kiyosaki, Rich Dad, Poor Dad, Cash Flow Quadrant. And, my entrepreneurial spirit was burning. And so I started Pilot Crash Pads, which is like a housing around airports for pilots. And eventually I bumped into my business partner, who was my neighbor in Washington, D.C. We started flipping houses. And while this was all going on, I had this eureka moment where I was renting a self-storage unit because I was doing a home renovation. And I thought self-storage was the dumbest thing ever. And so I literally, I'm renting this unit. The owner raises my rent 20% after I rented the unit for a few months. And I start realizing I got nowhere to go. I got no choice. I got all this stuff in my storage unit. I'm not going to go down there and move it. And then I realized he had 500 units. He could raise this 20, he could be raising the rents 20% on 500 people. And there's nowhere to go anyway. So it's, I always like to say the choices are you either eat the 20% increase or you throw your stuff in the trash. And I still needed that stuff in the renovation. The renovation, of course, took longer than I expected. Surprise, surprise. And so we're tinkering over here with flipping houses and stuff. And I'm like, this self-storage thing is incredible. It's 4 walls and a floor. There's nothing to maintain inside the unit. And this guy just popped my rent 20%. There's nothing I can do about it. And you could change the rents every 30 days. So I was like, man, this is something that I really want to get into. So that was when we kind of made that transition. But Yeah, airline pilot for 17 years. I have over 10,000 hours. Love to fly, have my own plane, do the whole private pilot stuff. Yeah, retired from the career about 4 years ago. Flew international, flew the 757, flew the 767, flew the 737 all over the world. Really had a great career and loved it. So,
hey guys, Gabe here. Have you seen the exciting new projects we have going on at Stack Asset Group? If you're interested in investing with us, click the link in the description below. So even after your first flight, when you said, I can't do this, you still did it for 17 years?
Well, it took me a little while to figure out what to do from there, but I actually got a job. I went through the whole, you guys know the cash flow quadrant, right? Employees, self-employed, business owner, then investor, right?
Did them all.
I did them all because when I was a pilot, I was an employee, right? Exchanging time for money, no big deal. But then when I became a consultant for the FAA. And so I was working part-time. I was living in Washington, D.C., and there was an airline crash in Buffalo, New York back in 2009. And I got a job basically working on Capitol Hill consulting for helping regulatory affairs. So I was self-employed. So now I'm paying the most tax, flexible work hours, sort of infrequent, but now I'm paying the most tax. And I was like, okay, I'm really good at working hard and working 80, 90 hours a week. But, you hear that famous quote, if you don't figure out how to make money when you sleep, you'll work till you'll die kind of thing. And I was like, that really struck with me. And then I was like, oh, this real estate stuff is something that I can actually understand. I wasn't a big Wall Street guy or anything like that. I didn't grow up in a family like that. And so real estate was kind of easy to grasp. And so I sort of started learning different things. And I probably listened to over 2,000 podcasts during that time frame, on my layovers, while I was doing house chores, while I'm jamming in the car, all the things that you guys probably do, reading, 12 to 25 books a year on real estate and business, and just the incredible amount of content that's on the internet. It's amazing. And then I spent time looking up the host, right? All right, who's this guy that's on this podcast? And they have a conference. I'm going to go to that conference and I'm going to meet the person that's on and I just wasn't afraid to ask for help and reach out to people and say, hey, how do you do it? How does this work? And really just educated myself for effective action, I think is really what the story is.
I love it. What made you make the final jump? Like, did it just take guts to finally do it, or what?
Well, I'm not like a lot of people. I know like our mutual friend Jan, he just like quit his job and jumped all in head first. And I'm not as gutsy as that. I need a lot more comfort. And so, being an airline pilot and being an entrepreneur, that provided me with income that was predictable while working really hard in my free time, in layovers and things like that. But that's not a journey that a lot of people take. I straddled both professions for a long time. And for me, as an airline pilot, like, if anybody's familiar with the industry, like once you kind of get into an airline, you don't really quit because you build seniority. And if you leave that airline and go to another airline, you lose all that seniority. If you quit, it's really hard to get hired back into where you were. So I was slow to give it up. And, ultimately the company, I fully replaced my salary at the airlines with my company's distributions and income, and then said, okay, this is a beast and it's getting in the way. And so that's when I elected to ultimately resign. But that was 6 years after starting the business. So I did not jump in headfirst very quickly at all. Yeah.
It seems like being a pilot, being in an airplane kind of makes the world feel smaller, doesn't it? It does. Does that play to your advantage now? You're talking about having people all over the place and having these operations going in different states. Like to us, that probably feels like, how in the heck do you manage that so far away? Do you think being a pilot kind of helped you wrap your mind around having an operation that runs across such a big footprint?
Yeah, I would say it's definitely, early on it helped, where I would be, flying, right when I got hired I was actually a pilot for Alaska for a little while before going to Delta. But when I was at Alaska, I'd fly the flights that went from Seattle to Washington, D.C. every week. And when I landed in D.C., it was awesome because I was building condos. And so I'd do this flight every week and I'd go get to walk the projects once a week on my layovers. How cool is that? Right. And so that was sort of like, hand in hand and very efficient. But as the progress of the projects, sort of wind down and you sell them and you move on, it's kind of like that route doesn't really apply anymore. I don't have any more projects there. And then maybe you might serendipitously get a layover in some city. You've got a self-storage property and maybe you got a minute to go there. But not really. I mean, it doesn't really line up that well.
But just from a mindset perspective is what I'm trying to get at. Like, I'm imagining the world seems like a smaller place to you than it does the average person.
It does. It does. I mean, getting on it's kind of funny. My wife, good question. And my story on that is like, my wife's like, "Are you packed?" It's like, "Yeah." I didn't even see you pack. Well, it only takes me 3 minutes, I mean, I'm used to putting clothes in a suitcase for 4 days and hitting the road. I mean, that's not a big deal. And I would say travel is not if you're going to get into this business, especially in self-storage, good luck trying to find all your projects in your own backyard, because there's only 50,000, call it 60,000 of these properties in the country, right? There's probably 60,000 multifamily duplexes and multifamily units in Seattle, right? So the reality is it's really hard to build and scale a portfolio in self-storage in your backyard. You've got to open up the aperture to go to multiple cities and multiple states to get the right amount of deal flow to hit your targets. And so I think like our first self-storage, it was kind of funny. I actually didn't have any projects in Washington until 2020 that I could drive to. And from 2014 to 2020, all of our self-storage projects were either in Texas, Colorado, Florida, all over the country. And so, one in Georgia. So it was funny when I finally had one in Washington. It was like I could drive an hour to one of my properties. This is awesome, So, and it makes you really good at remote management. How do you audit? How do you inspect? How often do you go? What do you do? How do you think about this? But yeah, it's a little bit of a leap. I would say that's probably the biggest leap is like buying that first property that's out of state that's got 100 tenants on it. I mean, that's a big deal. And, you shouldn't overlook the operational challenges that go into that.
Can you tell us a little bit more about how you remote manage? How do you pull it off?
Yeah. So today, everybody, I mean, for self-storage, it's great because everything's automated, right? So, you've got property management software that will send when somebody's paid and lock and unlock their gate, right? So you can't access one of our facilities if you haven't paid for 5 days. It automatically turns you off. And now they even make locks that will automatically, deadbolt your unit if you don't pay. So you're not getting into the property, but you're in the doors and all that. But now you're not even getting into your unit until you pay. And then the second you pay, the system recognizes the payment and unlocks your unit. I mean, that solves a lot of the world's problems right there. And booking a unit, you don't need somebody on site to book the unit. And so you can call our call center. It's 24 hours a day. You can go on our website, obviously 24/7. And we do have store managers at our site. You can hire a store manager there. And so software and technology has made this very out of the box and very, very remote friendly. The things that start to get you, right? Because it's like, okay, what's the catch? It's really hard to staff a facility that needs one person, right? Because if that one person quits,
no staff.
Then what? Right? So people think, oh, I can do this from California and I can buy a bunch of property on the East Coast. And, I heard this guy in a podcast. He told me I could just automate this stuff, right? And then they buy it. We end up buying properties from people like that all the time who just completely flub the deal because it's like, They thought, oh, this would be so easy, and it's not, because you got to chase around that one person that runs your site. I can find some part-time person. Oh, really? Who wants part-time work? Not very many people actually. We deal with this all the time in our 87 locations. Where we would love to have somebody who would only work 15 or 20 hours a week to go, because you still need somebody to sweep out the units. Somebody dumps a mattress in the drive aisle. You need someone to go pick it up right away. You have break-ins, you have issues. You want to advertise locally with your Chamber of Commerce and apartments and insurance companies and all this stuff. You need somebody there in the market. And ideally, you really need like a community advocate, somebody who gets it. I've got a guy down in Oregon who's just an awesome guy. Like, he's just this retired guy, and he's just one example of the many store managers that we have, where he's plugged in with the Chamber of Commerce, he's plugged in with the Rotary Club, he's plugged in with all the local stuff, and he just knows how to get stuff done. That's what you need, But even though you can automate all this unit stuff, it definitely lowers the weight off the manager. But you're never going to get away from needing a person to go to that property. It's just a thing. So,
do you have the typical once a week auctions on your units that get abandoned?
Yeah, first Thursdays of the month, you're going to have auctions. So for those that don't know self-storage, after 30 days of non-payment, the owner has the right to lien the occupant's belongings and post notices in the paper and auction off all your stuff. And everybody thinks oh, this is cool. Well, what have you found? And how much money can you make and all that. The reality is you can't make any money, because all the money goes to the client, the occupant, after you've recovered your expenses. So say, Gabe owes me $1,000 for back payment, and I spend $500 listing the auction on it in the newspaper, and he's got a Ferrari in there, right? And I sell the Ferrari for $100,000 at an auction. I only get my $1,500 that I lost chasing you around, and you get the rest of the money. So now, the reality is when we open that door, there's usually just a bunch of junk in there that no one buys, right? and a lot of people ask well, can you see it? Yeah, you can. You guys could. I don't know if you guys are sitting right now, but you guys could go to selfstorageauctions.net, allow to see your location, and it will show you all the auctions happening within a given market. And they're all posted. The doors are open. You can bid on self-storage crap. And we like it because what we usually do is we end up going and, the buyer of the stuff is usually the one who just rents the unit from us. So we kind of get the best of both worlds. We get some money from the delinquent tenant through the auction process, and then we get our unit back and get a new customer pretty much right away. So. Oh,
I see. They buy all the stuff and then rent it from you to leave it there.
Yeah, that's exactly right. Yeah, until they can come get it all or whatever they do with it. So.
Are those rules the same in every state, or does it vary?
They're almost identical in every state.
Okay.
So functionally, it might be 45 days versus 30 days. It might be 40 days. But at the end of the day, there are no tenant landlord laws.
Yeah.
Nobody gives a crap about grandma's heirloom or her dresser, right? It's getting auctioned off. People don't live in the units. There's no mechanism to protect the tenant or the occupant.
How do you determine which markets you're investing in?
Yeah, so we looked at, there's four. So if you look at the metropolitan statistical areas, which is just a fancy way of saying, if you look at every single city in America that registers people and has some kind of economic data, there's about 4,500 of those cities. We looked at all of them and basically said, which ones are the best for self-storage? And we took things like rents per square foot. They had to be above a certain threshold. We looked at population growth, job growth, income growth. We looked at major economic drivers. And we narrowed it down to 150 markets and basically said, okay, if a broker has a deal in one of these markets, we'll do it. Well, we won't do it, but we'll dive deeper into it. Mm-hmm. So, I'm from Detroit, so I can say bad things, but we don't go to Detroit. We don't go to Cleveland. We don't go to Illinois. We don't go to states like New York or California. So we've kind of eliminated. So now you kind of start, having a buy, deciding what your buying criteria is just as much as what you will buy. But it's even more what you won't buy.
Yeah.
So you want to get clear on where you won't go. And then so that way when a deal comes in, you can quickly say, oh, that's in California, put it in the trash.
Yeah.
Do you have a favorite market?
Yeah, I really like the Pacific Northwest. I think this market is robust. I think the market is underserved in general. Now, that doesn't mean the next deal you see is going to be a good one, but I think the market's underserved. So, there's generally, and if you look at the REIT reporting and you look at data, it'll tell you the same thing. The Pacific Northwest deals are generally highly occupied, and there's not a lot of supply, and that's there's a lot of reasons for that. Ranging from it's more difficult to entitle and permit. It's difficult because we have a lot of wetlands here. and there's limited zoning for self-storage. A lot of cities have put moratoriums on building additional self-storage in the PNW. And so, and there's higher and better use, for apartments and things like that. So a lot of the good land has been kind of gobbled up. So I like this market. I like Texas. I like Houston. It's been a great place where we've gone and done very well. But I really like markets where, I don't really look to say like, oh, I really like, Denver or Dallas or whatever. I like markets where there just hasn't been a lot built, or it's difficult to build self-storage and the occupancy is super high, because you can do a lot of damage in your business plan when you have a market like that.
And then when you're looking at specific deals, are you looking to achieve like a certain investor yield, a yield on cost, or what metrics are you looking at?
Yeah, great question. So yield on cost, and I don't know how much your listeners follow along on this, but basically, if you're going to build a brand new property, whatever it is, so in this case, a self-storage, when we build that property, when we look at the stabilized NOI, so when we look at the year that we're going to be full, we want to take that NOI and we want to divide that into our total cost to get there. Right. So how much was the land, the permits, the financing, the interest reserves, the construction costs? What are all those expenses? And we want to divide those two numbers together, and that's your yield on cost. That's effectively your cap rate for what you paid for that property, right? Because it's your fully loaded cost against what your stabilized rental rates are. And that usually is in like year 3 or 4. If you want to just use the end of your business plan, that's fine too. We want to see a 10% yield on cost or higher. So that way, when we look at what's all the money that goes in and what will we produce in income when we're stabilized, we want to see that be about a double digit. So ideally 10 to 11%.
Okay. And do you find that gets your investors a specific return you're targeting then when you find that deal type?
Yeah. So, we're targeting low 20% annual returns to net to the investor on an annual basis. Yeah. For something like that, call it 21 to 25% annual returns. And that allows us to comfortably back into a deal and achieve that investor-facing return over a 5 to 6 year hold period.
And then is that like IRR or AAR that you're looking at when you do those?
AAR.
Okay.
Yeah.
That's what we found is talking IRR to investors gets really complex, and we use AAR because you can easily explain it with math. Here's how much money you leave with. Here's the simple equation.
Yep. You can basically, the simple way that I like to say it is, if I'm making 20% AAR, which is annual, average annual return, it's like saying in 5 years, you can just multiply 5 by 20. You're going to make 100% of your money. You're going to double your money in 5 years, which is 20% per year. Mm-hmm. And that's usually our target, plus or minus 5%, plus the 5%, getting up into the mid 20s when you're talking about ground up development, because you're going to take on more risk as an investor. So I would expect better returns. And then if you're buying something more stabilized, we're targeting about 15% annual return.
Okay.
And I've seen all kinds of garbage out there saying they're going to 3x their money in 3 years. That's a bunch of baloney. I'm telling you right now, those deals do not exist. And if they do, I found this super secret deal. It just kind of shows people's inexperience. I think real estate, generally you can double your money every 5 years. Typically, you might get lucky, and you might have a track record of getting lucky, and that I'm happy for you. But it's very hard to do that at scale consistently.
Yeah.
You talked about market cycles a little bit. How have the last 3-4 years affected your business?
Quite a lot.
Positive or negative way? Has it been both. Hard? Okay, tell us a little. Tell us how the last 3 years have been for you.
Oh, they've been rough. Anybody
makes me feel better.
Yeah.
Yeah. I'm going to be the first to admit. Look, real estate market cycles are unforgiving and they're vicious. And one side of the coin, you may have talked to somebody that invested in a deal in 2017 or 2018, and they got out in 2020 or 2021, and they tripled their money, and they're like, man, this is awesome, And you might talk to somebody who did their first deal in 2022, and you kind of feel bad for them, right? Because they got this, they got excited about real estate, they saw what it was doing, and interest rates, went up the highest they've ever climbed over the shortest period of time in the history. And no one saw that coming. No guru saw that coming. No one called that. No economist knew that interest rates were going to go from basically 0 to 5.5%. over, 12 months or something like that. And it just crushed real estate. And, that's just a reality. I mean, sometimes you're going to get caught in that. And so we were buying properties actively, very actively, as a lot of people were in 2021 and 2022. And those properties have been a struggle. I mean, because we had higher than expected interest rate costs. We had climbing costs of of just everything, right? We had inflation, double-digit inflation through that whole entire hold period. And meanwhile, the consumer's pulling back. So, and rental rates are going to be lower than what you pro forma'd and projected. So, I don't wish losses on anybody. We haven't taken a loss. We haven't done a capital call. We haven't, we have never lost a dribble of investors' capital. We've always had a positive return on our exits, but going through what we've gone through has made us better operators. I mean, we've had to scrutinize everything.
Yeah.
And I can't wait. I mean, because the stuff that we're buying now is awesome. I mean, we bought deals, throughout 2024 and 2025 that, were distressed and under market and we put very little rent growth assumptions into that have grown tremendously in underserved markets. And it's been awesome. And meanwhile, our operations team has been so razor focused on some of these deals that were thinner because of the time that they were bought, the vintage in which they were bought in. And it's just sharpened the axe all the way across the organization. I mean, we've been so focused on operations for the last 3 years. I'm kind of excited to see what a more normal market's going to look like. So,
how did the last?
Sorry to go on.
I have a few questions for you. But how did the last few years affect your rents and vacancy specifically across your portfolio?
Yeah. So as an industry, we saw occupancy decline as much as 5 to 7%. So we saw occupancy take a pretty big dip, and for reasons, it's interesting. So you got to go back to, what happened, right? So interest rates were sub 3% for your home loan, fixed rate. Everybody bought houses like crazy, and then interest rates went up and everybody stopped doing stuff. They stopped moving. They're stuck in their house. Everything kind of put on hold because the cost of capital went up. And so when that happened is people stopped moving. And when people stopped moving, they stopped needing self-storage as much as they did when they were moving, right? Because, you think about it, when I sold my house in Seattle and moved across town, my real estate said, get all your personal crap out of here so I can stage your house, paint it, make it look good, and sell it. So my stuff went into a self-storage facility for 6 months, while I was looking for my new house, selling my old house, right? You guys know the game. That is gone, right? Because people are not buying houses. And in fact, if you look at America's mobility in 2024, the Wall Street Journal reported America's mobility as a percentage of the population is 8.3%. That's the lowest mobility rate we've had on record in our nation's history. People are not doing any moves right now. And so it's crushed the sales market for single family or for residential real estate. It hasn't declined the market. It just stopped the market. No one's really transacting. And so when that happened, the whole industry, the self-storage industry, we don't do well when the market is flat and people aren't really, there's not a lot of disruption. We do well when the economy is in a recession or when the economy is growing. And the reason is because when it's in a recession, people have to do different. They have to move, downsize, relocate, change jobs, move across town. They have to put their stuff in self-storage and go live with mom and dad for a while. Whatever it is, we do well when that happens. We also do well when people have money to spend, right? They're buying stuff, they're transacting, they're buying toys, putting it into storage units, whatever it is. But when it's just kind of humdrum, sort of flatline market, we don't do as well. So we lost about 5 to 7%. And we had to get aggressive in our strategies. We had to completely change our strategies as an industry. If you notice, there's a lot more $1 move-in free,
concessions,
first month free, 50% off concession. And the reason why we're doing that is because we move you in at some, teaser rate, and then 3 months later we pop you with a 200% rent increase. And so that's called a customer rent increase. An ECRI is what we call it in our industry, existing customer rent increase. And, we're recovering the same amount of revenue. If you actually look at our revenue's grown 4%, but our vacancy's down because we're doing this game where we move people in at a teaser rate and then pop their rents, a few months later. So, it's just been really tricky, and we've had to fight tooth and nail and really kind of call everything into question. I think if there was a theme that I could put on it, like, the thing that 2025, the thing that I look back on is there's no such thing as a fixed cost. Everything can be negotiated.
That's right.
You can cut payroll, you can cut insurance, you can cut your rates, whatever it might be. And so we've gone through every dollar in this portfolio. I mean, we have just to kind of tell you about what we do as an operations team, we get all of our district managers together on a monthly basis, all of our property accountants, we get them all together. We sit in a room and we go through every single line item in a P&L, profit and loss statement, and we question everything. So we look at, and it's kind of fun. We can use AI. We'll take there's an industry almanac that tells you what everything should cost as a percentage of your square footage. And we will put that into ChatGPT and then upload all of our P&Ls, and it'll tell you where you're off from, comparing the rest of the industry. And then we just kind of double click into those expenses and say, okay, where can we cut? What are we doing here, guys? So yeah, it's definitely, it's been a fun year. It's just been, everything is in question. So
some of these creative concessions you're talking about, like a loss leader move somebody in. Was that part of a playbook that came from other downturns, or is that something new you guys came up with in this cycle?
That was new, and I will not take credit for it. That was driven by the largest self-storage operator in the country, Extra Space. They basically just, if you think about, there's really 4 companies that drive the most of the market. There's CubeSmart, Extra Space, Public Storage, and NSA. Those are the 4 major publicly traded companies that are in self-storage. And Wall Street will weigh in on their stock price or dictate their stock price a lot based on how their occupancy is doing and their NOI growth. And so Extra Space is, consistently at 95% occupancy, 94% occupancy. When this whole little thing popped up, their occupancy took a hit, 3 or 4%, and they panicked and they said, what can we do? And they said, well, we'll just offer a better promo and then we'll just raise their rents faster. Normally we wait, 7 or 8 months, but now we're just going to wait 3 or 4 months so we can build back our occupancy, and then we'll readjust their rates. And it took the industry 6 months to figure out what the hell was going on. Because, think about it, as a competitor, you're in an inflationary environment as a customer, right? And normally you're only going to drive about 10 minutes, 15 minutes to your nearest facility. You're not going to drive that much further. But this guy now is offering $1 move-in. So you're going to drive now 20 minutes, right? Mm-hmm. So what have you done without even realizing it? It's like you've almost built more units in a market because you're lowering the price so much that you're expanding your radius that you collect your customers from. And so, we kind of were like, holy crap, all these people are leaving and they're going to the competitor. What are they doing? And then we kind of figured out, these people are going there. And then 3 months later, they're getting their rents popped incredibly. So we have data scientists and revenue analysts on our team. And we invested in some software that web scrapes, the daily rates that are published within a given market. And this is like a whole thing you've got to have a lot of team for, to kind of make sure you're staying competitive on these promos and your advertising and your move-ins and all that stuff. So, man, it was definitely a lesson learned for sure, and it really kind of revolutionized the industry from this shortage of people that are renting.
Yeah. As you're doing these single asset syndications, are you structuring every deal the same exact way, or do you differ how much you own based on how good the deal is?
More the latter, but also the former. So the structures end up all about the same, and we structure them based on how good the deal is, right? So we just basically say, here's a ground up development project. As an investor, if I put my money into that, I would want this return based on the risk that I'm taking, and then we back into the ownership from there. Mm-hmm. And so, but it's all like, you guys asked the great question, which is like, well, what kind of yield on cost are you looking for? That's going to be your foundation to being able to back into returns and then have it worthwhile for us, right? Because we don't just look at like how much the investor is going to make or how much the project's making. We look at like, well, what's in it for us? Because I'm signing on the loan, right? I'm actually going to take. That's great. You're investing $100,000 into my deal, but I'm signing up for $5 million of debt. And it's usually recourse. So you're a little, my risk is much, much greater than my investors. And so I want to make sure that, hey, what am I going to make? Because I don't want to sign on $5 million of debt to make a little tiny return. I need to make sure that it's my risk reward is there, because I'm taking on a lot of risk.
Yeah. Do you have a minimum percent of the deal you guys will own to do a deal?
No, I mean, that's kind of a complex question when you have sort of a layered waterfall. So like we have a preferred return, and then we have hurdle rates. So, not to get confusing, but we basically say, like, until you achieve a certain amount, the split is more favorable to the investor. And then as we hit certain benchmarks, we get more and more, and generally ends up, it usually ends up in like a preferred return. So that means the investors get 100% of the money until their preferred return is met.
What do you target?
Then it might go
return usually.
Depends. Anywhere from 6 to 10%.
Okay.
Just depending on how much you invest. A lower investment amount is going to get a lower preferred return, and then we tier it. So if there's a higher investor capital contribution, they'll get a higher investor preferred rate of return.
Yeah. And then have you ever looked, because now you're doing like really large deal volume, so at some point, like, you're finding too many deals, you don't have enough capital. Have you looked at like going to pension funds or like those types of people to start funding this stuff for you? Because now you have the track record to tap into that.
Yeah, I would say, we raise about $120 million a deal or a year. So we raise about $10 million a month is about how much investor cash is coming in. That means that we can buy about $240 million to $250 million a year. I don't think we want to be buying any more than that. Okay. I think that's a healthy amount of growth against, the team and expanding the footprint and how many people you can hire. I would say it's pretty balanced. I always like to give the analogy, raising money and finding deals is like chips and dip. When you're at a party, you usually have too much chips or not enough dip, or not enough dip and too many chips, and it never seems to work out. Maybe it does for the first part of the year, and then it sort of like gets uneven. And I kind of feel right now it's pretty balanced, and I want to keep it that way. We looked at an institutional equity in the past, and it sucks, guys. Like, you don't want it. No one wants. That's no good for anybody. That's, like Grant Cardone says, that's dirty money. And it's dirty money. It's this investment bank is putting the money in the hands of this investment broker who's taking 2%, and this guy's taking. And, at the end of the day, they're going to say, well, you probably get a better deal with your retail investors because they don't know any better. And it's like, no, I'm getting a better deal with my retail investors because I don't got to pay my broker, and I don't got to pay my investment banker. I don't have to, and by the way, you're not even putting any money into this deal. You're just getting paid to facilitate this transaction. And, if you look into the returns that you get, and if I wanted a job, I'd just go fly for the airlines. Yeah. When you start taking institutional money, you have a job, and you're working for some 27-year-old Harvard grad, who's going to be in all your meetings and dictating what you buy and what you can't buy. And, what fun is that? I mean, that's not entrepreneurial at all in my mind. That's just sort of somebody telling you what you can and cannot do. Mm-hmm. So I think there's a lot of benefits to growing and maintaining your own investor list, building your own investors. And, some people say, well, that's a lot of work. Well, yeah, it's a lot of work. This whole thing is a lot of work. Having enough salespeople and support and, being able to provide a great service to your investors is a lot of work, but it's worth it. I mean, you should see some of the term sheets you get from these institutional people. And we did the whole thing. We went to New York and met with all the big, JP Morgan and Wells Fargo and TPG and Brookfield and all these guys. And they just, they want their pound of flesh. And, then you have clawbacks. If you don't perform, they can take back the deal from you. And no, I'm good. I'm good.
So raising $10 million a month sounds insane to me. That's a lot of money. So how did you build up to doing that? Like what did the start of your capital raising look like, and how did you build it over time?
Yeah, the first thing you got to get right is taking care of the people that put the money with you. That's the first thing you got to get right. It's not about some drip campaign or what fancy CRM you're on. You have got to be a fanatical communicator. So you've got to understand, the EQ that goes into what an investor wants to hear and how frequently they want to hear it. And you got to deliver that. You got to give them updates. You've got to let them know what's going on with the project. And it's a fine balance of, how much do you tell them? and how much do they really need to know as a passive investor? I understand to you want to know every little nickel and dime that goes in, but how much do they really want to know? And what's important to them? And so I think it's so much about taking care of who you get versus trying to find the next one. Mm-hmm. And we so much time and effort into that. Investor updates are robust. We share full financials, full P&L. We provide a private link to your deals. We provide pictures and updates and all financials, all move in and move out data, and all these things, to the investors to keep them well informed. And I would invest in that first, because you're going to get way more investors from referrals or word of mouth. And eventually your investors are going to say, hey, I want to talk to somebody who's done some of your deals with you. And so that's kind of where, I would start. And then, of course, you're going to need, a marketing drip campaign and CRM. And, I think, I started a podcast 3 years ago that helps with leads. And you can go to conferences and speak at shows and get to meet people and get out there and network. That's really the gist of it. And then just be ready to handle the calls and be ready to handle the questions. I mean, having 2,000 investors like we do, I mean, you got to have a team that's ready to answer questions, or you're gonna run yourself right into the ground. So, being able to have a good asset management team that's reporting and able to, answer pretty detailed questions is super important.
What did that scale look like over time? Like, how much were you raising when you started, and when did you get it up to this point?
Yeah. So, what was the question one more time?
Yeah, how you got to 10 million essentially, because that's a month, because that's crazy. So when you were starting, you were probably raising $50,000 to $100,000 chunks. So I'm assuming on your house flips, and you kind of started learning and building it from there. But how did you really get to 10 million?
Yeah, I mean, you kind of gotta, one thing, once you kind of get established, right? You're gonna, the chips and dip mentality. As the deals get bigger, the check sizes, get bigger, and what comes first, the chicken or the egg? Do you got to go find all those investors, or do you have to find the deals? And here's my 2 cents on that. It's always about the money. It's never about the deal. And I'll argue anybody to the end. And I'd love a contrarian argument on this. Here's the way I look at it. If you found $1 billion worth of really good deals to buy, could you go buy them?
No.
No, because you can't. Because you don't have $1 billion of investors. Right now, let's say you had let's say you could go find $1 billion of deals. You probably would be like, yeah, I would do $1 billion of deals. Maybe, I don't know, maybe your preferences are just keep it smaller. But at the end of the day, you would go do it, but you don't have $1 billion network. So it's always about the money. It's always about getting yourself out there and getting yourself in front of more people, because once you have the money, the deal finds you. And here's what I mean by that. The number one, the top self-storage brokers in the country, they'll call us and they'll say, hey, this is a Spartan deal all day long. You want to do it? I'll actually invest in it. They'll call us. I mean, they're not calling, and they'll say, hey, I can't steer it your way, but you should do this deal, and it's a good deal, and I want to invest in it. And if people know that you can close, then you'll end up on short lists, and if you don't have any money, you can't do that. Mm-hmm. So I would say, there has to be an emphasis on building your network. And so that starts with newsletters. Do you have a newsletter that goes out? You may have no track record, so then you need to talk about your investment thesis. What are you buying? What kinds of things are you looking for? So that way you've warmed up your list to know what they are expecting to see from you. Right? Mm-hmm. Be obsessive about click rates, open rates, who your number one fans are. Be obsessive about their personas. What do they care about when you talk to them on the phone? What are they telling you? Are they telling you they really want to save taxes? Well, then that's what you talk to that investor about. Are they telling you that they're really impressed with the deals that you find and the operations team that you have? Then that's what you talk to them about. Are they really concerned about, this or that? You gotta capture that data and then study the data and see what's working. I do a ton of LinkedIn stuff. That's no secret. I, speak at a lot of conferences and events. That stuff is gold. People go into these events, they want to meet you, and I'd say probably that's a really important thing is, I call it kind of like the trifecta. People got to know you. And that usually takes having 7 to 10 touch points. You know, they email, they saw you, they heard about you, they met you at a conference, they went to your office, they went to a property tour. They got to like real estate, and then they got to like the market, right? And so those 3 things kind of line up. You're going to have an investor that usually converts. So just any way you can build your list and any way you can take care of your people, you're going to get more people.
Yeah.
More often than not, I got a guy and he's kind of being a pain, but he's, hey, I'm checking out a bunch of different deals and can you send me your investor reporting for the last, 30 months on this? Sure. Right. Okay. Oh, well, you're the first group that said they'd actually do something like that. It's like, well, I've got a support team that can put that together for you in 5 minutes. I'm not doing it.
Yeah.
And so like having that support team is just as important as having a good sales guy, because you can be responsive. Are you answering an email at 10 a.m. on a Saturday? How fast are you getting back to people? We have a whole support team that's in my sales team's inboxes, responding to every email as it comes in.
Dane told me about your work ethic when he was at the event you were at, and you were speaking at like 11 p.m. or something, then up at 5 on the phone, taking meetings all day. So.
Yeah, I was trying to prove a point because we were like a mastermind, and I was running all the time anyways. But I was like, well, mastermind, breakfast is at 7. I'm just gonna get up and like go for a run. I had ran like a few miles or whatever, and I got back, and I think you were 45 minutes into a meeting, and it was like 5:45 in the morning. And I was like, what in the world? I thought I was the only one.
Oh, that's right.
And you were sitting down on the couch and you were talking to an investor like in New York or something. You're like, well, it's 8 a.m. their time. I was like, I guess so. Yeah, sure. Yeah, no, I was rattled, but I was impressed. So that was part of why I started following everything else that you did. Was because I was like, oh, he's not just talking. Like, he's actually doing all of the stuff that it takes to raise $10 million a month. So what did it look like in like 2020? That's kind of when it looks like or maybe 2019 is when you guys kind of skyrocketed, for lack of a better term. You had the construction company rolling, it looks like, and then really started to acquire quickly.
Yeah, I would say, I'd attribute a lot to it on when you hire somebody or when you try to recruit somebody to your company or you try to recruit an investor, people really love clarity, right? So, when somebody looks into your organization, they want to see the clear vision of who you are and what you're trying to do. And I think, I give a lot of props to my business partner, Scott, who always set a strategic plan, and you guys can download ours right on our website. And, it's like, here's our goals, here's our mission, vision, value, here's what we're trying to do over the next 3 years, and here's how you can be part of it. And when a new hire comes in and they're evaluating if they want to work for Spartan, they come to the interview, and I've interviewed hundreds of people that work here. It's like they say all kind of the same thing. Like, it's very clear what you guys are all about. I understand the mission, the vision, the purpose, and I can see where you guys are headed, and I want to be part of it. And the same thing happens with investors. They're interested in self-storage, and there's some people who are really into that, but they kind of were like, they're kind of really investing in me and in Scott and in our people, because it's clear, right? And so I think the more clear you get in your goals and your vision and your direction and what you write down, the clearer it becomes for everybody. And then everybody's like on the, like I talked about what we won't buy. Well, that's clear for everybody now. Yeah. I talked about where we're going in the next 3 years in our strategic plan. Okay, well, that's clear for everybody. So many business owners, I sit down and they say, I just can't get people to buy into what I'm doing. And I'll say, my first question is, what is your mission statement? Well, it's to like do real estate and stuff. It's like, that's not a mission statement, man. Like, you don't even know what your mission is. How can you expect somebody who's, working on your team to understand what the mission is? So I give a lot of credence to Scott and what he's, the kind of the strategy and vision there. And then, the other part of that is, nothing happens until somebody sells something. And you got to be persuasive, and you've got to be able to articulate your plan. Any employee should know what does Spartan do? Somebody walks up to somebody at Spartan, what do you guys do? The 3F model. We find deals, we fund them, we finish them. That's it. And you can use that architecture to answer any question from it. Simplicity is really a winner. And, so we got clear on our acquisition goals. We said, hey, we want to buy this many properties this year, right? So we said, okay, we want to buy, whatever it was, 150 million this year. Okay, well, if we want to buy 150 million, how many LOIs do we got to get out the door? Okay, if we want to get that many LOIs out the door, how many deals do we got to look at every day? Okay, if we want to do that, how do we web scrape every single self-storage listing site to make sure that we're on every single one? And then we got to be at all the trade shows. We got to be meeting with all the brokers. We got to be, we got to clean up our email list. We got to, and you sort of back into this, right? And all of a sudden, you got clarity with your investors. You got clarity with your acquisitions team. You got clarity in your vision so your employees can get bought in, and you roadmap it. And one thing that, I'll say we've done 11 years in a row without missing is we always have a leadership offsite every quarter. And we check in, we unplug, we look at our strategic planning, and we decide what we're going to do. And that aligns everybody with what the plan is, that's going to go on. So
how many people are on that team? Because we do a similar thing, and we've kind of bounced back and forth between like how many people, like where does it end, I guess, like who goes and who doesn't?
Yeah. So here's what I would recommend, and here's what we do. So we have it's the C-suite, right? So it's finance is represented, finance and accounting. So our VP of finance, people are represented, we have a VP of people that, make sure that we're going in the right direction. She does tech as well. And we have construction, property operations, and then me and Scott.
Okay.
Are the kind of the team, right? So you got finance, operations, construction, and people all represented at the table. And then, one of the big challenges over the last 10 years has been building upcoming leaders, right? You want to make sure that you're bringing leaders up through the organization and kind of developing talent within your company. Because I'd rather not hire any outside managers. I'd rather have them all homegrown. They start as a property manager and they work their way up. I'd much rather have that. But that's harder to do when you're nascent. Like we're only like 10 years into this, right? So it's hard to get that, that rhythm. So we invite in on the second day of planning, we invite in what we call our operational leaders. So that's like our directors, our managers, and that's a small group too. It's a cohort of kind of middle management, for lack of better terms. And they come in and we hear from them, right? So we do icebreakers with them. We want them to brief us on specific topics. We want to brief them on what the plan is. We want to get their feedback. So they're not in the whole planning session, but they're in part of it. And that gets them kind of used to being in that executive level reporting environment.
You said you had 58 people overseas. How do you integrate those people into your mission and your vision and your culture?
Oh, man, that's a great question. They love our mission and vision and culture. And I would say if you're going to have 58 people overseas, you better have one because it's hard enough to be American versus Filipino, let alone not having a aligned mission. I mean, they love our culture. I mean, it's all over the walls in the office. We've got our, Spartan stuff. We have our mission, vision, values on the wall. We hired one of the guys there is our director of operations, and he embodies our vision and what it takes to be a Spartan. He's involved in all the hiring of all the employees there. He's involved in all the culture discussions with all of our leaders. Really just, and you include them in everything. We have sync calls every Monday. We just got off our sync call with our team here, an hour ago. We involved them in our sync calls. We involved them in our one-on-ones. We treat them just like any other American employee out there.
What are they doing?
They're part.
What's their role in the team?
Everything. We have all of our property accountants, financial analysis, fund accountant, marketing, investor relations support, call center, asset management, acquisitions, underwriting, payroll, human resources, construction, estimators, everything.
So you're doing
data.
You're doing projects overseas too?
No, they're just helping with estimates. So like they're doing construction project management, overseas, but we're just doing projects in America.
Okay. And you do that, I'm guessing, because you can get a real good talent pool for a lot less expense? Yeah,
two reasons. It's been very difficult on hiring in states like Colorado and Washington, in blue states. Very difficult, very expensive. But then also, like, it allows us to have a 24-hour operation over there, which has been very productive. So cost and productivity are really the two drivers.
Wow. So they're not really they're not VAs. They're your team overseas.
They're our team. They have Spartan polos on, and they're Spartans just like us.
I love it.
Yep.
That's awesome. Wow.
Yeah. And that's what's called a BPO, business person operations. And in Manila, like, you go over, I mean, I traveled over there this time last year, and, you know, JP Morgan Chase, Wells Fargo, all the big financial institutions have centers there. And lots of American companies have what's called BPOs, where they have their own office space. You card in, card out. And, you know, the BPO is, you know, part of helps you kind of run an entire team over there. Very, very pleased with how it's gone. A lot of the tasks they can do better than us, better than us Americans.
How long have you been doing that?
Almost 2 years now.
Okay.
We started in June of, it's like May of 2024. So rounding the corner here on about 18 months, 20 months, something like that.
So did you eliminate some positions here stateside to do that, or was it just part of your growth strategy?
Both, actually. That's a great question. So not only did we eliminated millions in payroll stateside, but the bigger savings came with we were doing a lot of third-party vendor contracts, like outsourcing design or outsourcing certain things externally, and we brought that back in house and we have our Manila team support that. So we have a lot of like marketing. We would outsource marketing like crazy to designers and things like that. We don't do that anymore. It's all done in house.
Wow. So are they doing some of the like architect and design plans too? Is what it sounds like. Like just
they're doing mostly estimating.
Okay.
Yeah, mostly pre-design and estimating, or pre-construction estimating stuff. So not necessarily like drawing, you know, and designing, but I think we actually may have recently hired somebody that's doing that now. I don't have the total details on what they're doing, but they have 6 people on the construction team in Manila.
Wow.
And they're really good. They're really good at what they do.
That's very cool.
It's impressive.
Yeah, that's very cool. That sounds. Do you think that you could have done that earlier on, or do you think that the timing just made sense and you were your hand was forced because you wanted lower payroll?
I wanted to do this in 2015. I just didn't know how. Yeah. And, you know, one of my investors, actually a really good partner of mine, he runs the company that does this out over there. And just one Saturday afternoon, you know, speaking of networking, you know, he said, "Hey, have you ever thought about, you know, offshoring?" And I was like, "Yeah, you know, I know all these guys that have like VAs and they do put stuff on Upwork." And he's like, No. I'm talking about hiring your own people, your own office, and having your own team over there. And I was like, "Tell me more."
Yeah.
You know, and then he kind of is like, "Yeah, you know, I've helped," you know, he has thousands and thousands of people that, you know, are basically it's a contract, right? So, you know, we contract with him, and then he, you know, his company, he's got a whole support team over there. They've got a big high-rise office, and we got to carve out. So they supply all the computer equipment, office supplies, everything, and, you know, give us the infrastructure to basically set up a whole operation over there. That's been awesome. So, yep.
Very cool. Wow. I mean, I don't know how much we will keep going all day long. Are you good on time?
You got a deal to close.
I know that you have a very tight schedule. And
what's that?
And it's the holidays.
Yeah, so I should probably wrap up here in the next 5. So whatever you guys want to do. Yeah.
Is there anything we haven't asked you that you would like to talk about? What's the end goal for you? What is the guiding light?
Yeah, so I would say, you know, I'm 41. I got a lot of fighting years left, and you know, I'm kind of excited to see where it goes. You know, our 3-year strategic plan, we want to grow to 300 stores. So that's, you know, quite a bit. You know, it's doubling the footprint again, basically, more than doubling, tripling. I think it'd be fun to do like, you know, the thing is when you're a syndicator, you're kind of in this like 5-year business plan where you're buying a deal, you're funding it, you're operating it, and you're trying to sell it in 5 years, and you're sort of get out. But, you know, the billionaires that I've sat down and talked to is like, that's not how you get rich. The wealthiest people that I know don't sell properties. They keep them. and they've never sold a property. And so, I'm really thinking about is how do I take the assets that I own now, satisfy my investor wants and needs, and roll these investments into a long-term vehicle. Whether that's like some kind of fund that goes longer, or sometimes, we go into like a private REIT structure and do an UPREIT exchange. And because these properties we own are really nice properties, low maintenance, good locations, hard to build in markets. And I want to kind of figure out how to take this, and own these assets for a long time. Some of them I want to get out of, right? Some of them are you get over your skis or the market gets overbuilt, and yeah, let's cut and run, let's make our money and move on. But that's my end goal. Is I want to build a portfolio and in a company that outlasts me, and I think I'd really enjoy that.
Do you think, are you creating enough equity within these properties where it's enough for your down payment essentially for your company where you can keep it?
Yeah, I mean that or just I want to partner with investors that want to be a little bit more long term.
Yeah,
kind of see the world that way. And as we've really upgraded our investor network quite a bit to bigger check writers and people who kind of think more that way. Because the super rich know that you don't get money on selling properties and paying taxes. Like you make money by putting really good assets in your portfolio and you hang on to them for a long time, and they just turn into cash machines, and you never pay the taxes on them. So I think as we mature and as we get bigger, I think more and more people will be more in that camp as well. So
yeah, that makes sense. You said you have 2,000 investors, but how is that number changing right now? Like, I assume you're getting a lot of bigger and bigger checks, and so are you trying to get that? I don't want to say get that list down, but isn't it beneficial to you at some point to do that?
It makes no difference. I mean, the thing, the kind of the thing that you're going to wrestle with, right, is like, I have friends that are in the space that have really big investors, right, and so they get a deal, and their investor will take the whole thing down. All that's really cool. Until that investor doesn't like your deal.
Yeah.
Right?
Yeah.
And it's like, oh, you want to do that deal? Oh, I don't do deals in Texas. I only like to do deals in Florida.
Yeah.
And now you're not doing the deal in Texas that you want to do. So having a bunch of little investors is great.
Huge.
Because they're like, yeah, I'll do that deal. I got $100,000. I'll do that deal. And the next thing you know, you got all your money. So I like having not necessarily a big check writing portfolio. I like to have a diversified portfolio of investors where everybody's kind of got different needs and wants, and it's just perfect because you always are going to have your funding sources.
That makes total sense.
Ryan, it's been really great having you on Deal Junkies today. You've been a wealth of knowledge. Thank you for sharing your time and wisdom with us. If somebody wants to invest with you or reach out to you, how should they get in touch with Spartan?
Yeah, our website is spartan-investors.com, or you can email me, ryan@spartan-investors.com. You can find me on LinkedIn. You can Google Ryan Gibson self-storage. I also have a podcast called Passive Income Pilots, and it's not just for pilots, but it's pretty focused on aviation professionals that want to learn how to invest. But yeah, those are a few ways to jump on our list.
Awesome. Ryan, thanks so much. Ryan Gibson with Spartan. Thanks for being with us today. Deal Junkies, thanks for listening. We'll see you next time.